Monetary policy is like juggling six balls. It is not interest rate up, interest rate down. There is the exchange rate, there are long term yields, there are short term yields, there is credit growth. By Raghuram Rahan. Good day, everyone. I am Ivy Rose Pitimbangan, together with my co-reporters, Ms. Sarah Jane Sara, Mr. Christian Saranya, Ms. Justin Zenetta Bokilde, Ms. Tiffany Tawaging, Ms. Mary Chris Tanazan, and Ms. Annalisa Tubat. We are going to discuss the lesson 2 about factors that influence exchange rates. The specific learning outcomes are the following. First, to discuss the International Monetary Fund and its role in determining exchange rates. Second, to explain the key factors that affect foreign exchange rates. And lastly, third, to discuss the business implication of exchange rate changes. But before that, let us first define exchange rate. So what is exchange rate? The exchange rate or the price of a currency in a free market situation is influenced by economic growth, interest rates, and inflation, market behavior, and government action. An exchange rate represents the number of units of one currency needed to acquire one unit of another. Therefore, the exchange rate is the price of a country's currency in terms of another currency. For example, if the exchange rate between the US dollar or USD and the Japanese yen or JPY is 120 yen per dollar, 1 US dollar can be exchanged for 120 yen in foreign currency markets.
Good day, I am Sarah Jane Rimoli Sara. I am assigned to the topic the International Monetary Fund or IMF. What is the International Monetary Fund or IMF? The International Monetary Fund or IMF is an international organization that promotes global economic growth and financial stability. It encourages international trade and reduces poverty. The International Monetary Fund or IMF was originally created in December 27, 1945 as part of the Bretton Woods Agreement, which attempted to encourage international financial cooperation by introducing a system of convertible currencies at fixed exchange rates. The International Monetary Fund or IMF began financial operations on March 1, 1947. Origin and objectives of International Monetary Fund or IMF. 29 countries initially signed the IMF agreements. There were 187 member countries as of July 1, 2011. The fundamental mission of the International Monetary Fund or IMF is to first, promote international monetary cooperation and exchange rate stability. Second, facilitate the balanced growth of international trade. Third, provide resources to help members in balance of payments difficulties or to assist with poverty reduction. Main function of International Monetary Fund or IMF. The International Monetary Fund or IMF employs three main functions: surveillance, financial assistance, and technical assistance to promote the stability of the international monetary and financial system.
Good afternoon, everyone. I am Christian Saranya. Now let's proceed to Bretton Woods and the principle of par values. The Bretton Woods Agreement established a system of fixed exchange rates under which each IMF member country sets a par values for its currency based on the gold and the US dollar. Because the value of the dollar was fixed at $35 per ounce of gold, the par values would be the same whether gold or the dollar was used as the basis. This par value becomes a benchmark by which each country's currency was valued against others. The IMF today, the quota system, it contributes a certain sum of money called a quota, broadly based on its relative size in the global economy. The IMF can draw on this pool of money to lend to the countries, and it uses the quota as the basis of how much a country can borrow from the fund. It is also the basis on which the IMF allocates special drawing rights or SDR. Moreover, the quota determines the voting rights of the individual members. In addition to identifying exchange rate regime, the IMF offers a great deal of aid to member countries, negotiating with them to provide financial assistance if they agree to adopt certain economic stabilization policies. Special Drawing Rights or SDR. SDR is an international reserves asset created by the IMF in 1969 to supplement its member countries' officials' reserve to support its currency and foreign exchange market.
Good day everyone, I am Justin Zanita Bukilde and I am assigned to discuss the evolution of exchange rate.
Exchange rate arrangement. Any person, any foreign exchange contract, currency swap agreement, or other similar agreement as to which such person is a party or a beneficiary, designed to provide protection against fluctuation in currency exchange rate incurred in the ordinary course of business. Three choices: hard peg, soft peg, or floating agreement. Hard peg. The government choices an exchange rate. A central bank can intervene in exchange market into two ways. It can raise or lower interest rates to make the currency stronger or weaker. It can also make directly purchase or sell its currency in foreign exchange market. Soft peg. A soft peg is an exchange rate policy where a government allows the exchange rate to be set by the market, but in some cases, especially if the exchange rate appears to move rapidly in one direction, the central bank will intervene in the market. Countries uses soft peg include the Chinese yuan, an interesting soft peg currency as it is softly pegged to the US dollar while also being a reserve currency, the Venezuela bolivar and the Hong Kong dollar, which are both pegged to the US dollar. Floating arrangement. Floating means you're willing to take the risk that interest will go up in the hope that they'll actually drop further. If rates have been dropping, then you might want to take a chance and hope that rates will be lower by the time you close your loan than they are willing today. Bank for International Settlement, an international financial institution offering banking services for national central bank and for a forum of discussing monetary and regulatory policies. Black markets, an economic activity that takes place outside government sanction channels. Illegal market transactions usually occur under the table to let participants avoid government prices controls or taxes.
This is Stephanie Tawaging, and I'm going to discuss the foreign exchange convertibility and controls. Some countries with fixed exchange rates control access to their currencies. Fully convertible currencies are those that our governments allows both residents and non-residents to purchase in unlimited amounts. Hard and soft currencies. Hard currencies such as the US dollar, euro, British pound, and Japanese yen are those that are fully convertible, highly liquid, relatively stable in value over a short period of time. They are generally accepted worldwide as payment for goods and services. They are also desirable assets. Currencies that are not fully convertible or soft currencies have just the opposite characteristics. They are very unstable in value, not very liquid, and not widely accepted as a payment for goods and services. A major reason why countries restrict the convertibility of their currencies is that they are short on foreign exchange reserves and try to use them for essential transactions. That is why soft currencies tend to be from developing countries where foreign exchange reserves are low. The higher the reserves, the less a country has to resort to restricting convertibility. It is interesting to note that many developing countries dominate the list of nations with the highest foreign exchange reserves. Despite that, when paying for export and imports, they need to go through hard currencies such as the dollar, euro, and yen. Most currencies today have non-residence or external convertibility, meaning that the foreigners can convert their currency into the local currency and back into theirs as well. Tourists generally have no problems doing this, although sometimes countries put restriction or condition on the trade from the local currencies back to the hard currencies when tourists leave the country. Controlling convertibility. The device that is used to conserve scarce foreign exchange. Some governments impose exchange restrictions on companies or individuals who wants to exchange money are the following. First, licenses. Government licenses fix the exchange rate by requiring all recipients, exporters, and others who receive foreign currency to sell it to its central bank at the official buying rate. Second, we have the multiple exchange rates. Another way government control foreign exchange convertibility is by establishing more than one exchange rate. This restrictive measure is called a multiple exchange rate system. The government determines which kind of transaction are to be conducted at which exchange rates. Countries with multiple rates often have a floating rate for luxury goods and financial flows, such as dividends, and a fixed, usually lower rate for the other trade transactions such as imports of essential commodities and semi-manufactured goods. Next is the import deposits. In this case, the government tightens the issue of import licenses and requires importers to deposit with other central bank, often for as long as 1 year and interest-free, covering the full price of manufactured goods they would purchase from abroad. Quantity controls. Government may also limit the amount of exchange through quantity controls, which often apply to tourism. A quantity control limits the amount of currency a resident can purchase from the bank for foreign travel.
Once again, good afternoon everyone. I am Ivaros Pitimbangan. In the continuation of Ms. Tawagin report, I am going to discuss the exchange rates and purchasing power and exchange rates and interest rates. Exchange rates and purchasing power parity. So when we say exchange rates, it is the rate at which one currency can be exchanged for another between nations or economic zones. It is used to determine the value of various currencies in relation to each other and is important in determining trade and capital flow dynamics. On the other hand, the purchasing power parity or PPP is a well-known theory that from the standpoint of exchange rates, it seeks to define the relationship between currencies based on relative inflation. In essence, it claims that a change in relative inflation between two countries must cause a change in exchange rates to keep the prices of goods in the countries fairly similar. For example, according to this theory, the PPP theory, if say Japanese inflations were 2% and US inflation were 3.5%, the dollar will be expected to fall by the difference in inflation rates. Moving on, exchange rates and interest rates. Although inflation is the most important medium-term influence on exchange rates, interest rates are also important. Interest rate differentials, however, have both short-term and long-term components to them. In the short term, exchange rates are strongly influenced by interest rates. In the long term, however, there is a strong relationship between inflation, interest rates, and exchange rates. To better understand this concept, we need to examine the two key finance theories, which are the Fisher effect and the International Fisher effect. So when we say Fisher effect, it links inflation and interest rates. It is the theory that the nominal interest rate in a country or the actual monetary interest rate earned on investment is determined by the real interest rate or the nominal rate less inflation and the inflation rate. Fisher effect is an economic theory that is created by economist Irving Fisher that describes the relationship between inflation and both real and nominal interest rates. The Fisher effect states that the real interest rate equals the nominal interest rate minus the expected inflation rate. So, the Fisher effect is an important relationship in macroeconomics. It describes the causal relationship between the nominal interest rate and inflation. It states that an increase in nominal rates lead to a decrease in inflation. On the other hand, the international Fisher effect that links interest rates and exchange rates. It is the theory that the interest rate differential is an unbiased predictor of future changes in the spot exchange. The International Fisher Effect or IFE is an economic theory stating that the expected disparity between the exchange rate of two currencies is approximately equal to the difference between their countries' nominal interest rates. For example, if the International Fisher Effect predicts that the nominal interest rates in the United States are higher than those in Japan, the dollar's value should fall in the future by the interest rate differential, which will be an indication of a weakening or depreciation of the dollar. That is because the interest rate differential is based on differences in inflation rates as we discussed earlier. Therefore, the Fisher effect and the IFE or International Fisher effect are related models but are not interchangeable. The Fisher effect claims that the combination of the anticipated rate of inflation and the real rate of return are represented in the nominal interest rates. The IFE expands on the Fisher effects, suggesting that because nominal interest rates reflect an anticipated inflation rates and currency exchange rate changes are driven by inflation rates, then currency changes are proportionate to the difference between two nations' nominal interest rates.
I'm Tenasan Mercuries. I will discussing the topic is key factors that affect foreign exchange rate. First is inflation rates, meaning changes in market inflation cause changes in currency exchange rates. A country with a lower inflation rate than another will see an appreciation in the value of its currency. The prices of goods and services increase at a slower rate where inflation is low. Second is interest rate, meaning in the interest rate change in interest rate affect currency value and dollar exchange rate. Ang forex rates, interest rate, and inflation are all correlated. Increases in interest rate cause a country currency to appreciate because higher interest rate provide higher rates to lender thereby attracting more foreign capital, which causes a rise in exchange rate. Number 3 is a country current account or balance of payment. A country current account reflects the balance of trade and earning on foreign investment. It consists of the total number of transactions including its exports, imports, and debt. Balance of payment fluctuates the exchange rate of its domestic currency. For example, balance payment is just called trade credit, so where can import purchase good from overseas and does not pay for the goods until they are not received. Next is number 4, government debt. Government debt is a public debt or national debt owed by the central government. A country with a government debt is less likely to acquire foreign capital, leading to inflation. Foreign investors will sell their bonds in the open market if the market predicts government debt within a certain country. Example, a country gross government debt, also called a public. So, public debt. So, or a sovereign debt is the financial liabilities of the government is a sectors. Number 5 is term of trade. Related to current accounts and balance of payment, the terms of trade are the ratio of export prices to import price. A country term of trade improve if its export prices rise at a greater rate than its imports prices. As a result, in higher revenue which causes a higher demand for the country currency and an increase its currency value in appreciation of the exchange of rates. 6 is political stability of performance. A country's political state and economic performance can affect its currency strength. A country with less risk for political turmoil is more attractive to foreign investors. As a result, drawing investment away from other countries with more political and economic stability. An increase in foreign capital in turn lead to appreciation in the value of its domestic currency. But a country prone to political confusion may see a depreciation in exchange rate. 7 is recession. When a country experiences a recession, its interest rates are likely to fall, decreasing its chance to acquire foreign capital. As a result, its currency weakens in comparison to that of other countries, therefore lowering the exchange rate. And the last one is number 8, speculation, meaning if a country currency value is expected to rise, investors will demand more of the currency to make a profit in the near future. And the result is the value of currency will rise due to the increase in demand. When this increase in currency value comes a rise in exchange rate as well. Then,
Hello, this is Annalisa Tubat, and to continue the report, I am going to discuss the business implications of exchange rate changes and the effect of these changes in marketing decisions, production decisions, and financial decisions. First, let us define what is exchange rate. Exchange rate is the price of one country's currency in terms of another country. We can say that there is an exchange rate changes when appreciated is happens or the value of currency increase and depreciated when the value of currency decrease. So what is really the implication of exchange rate changes in terms of marketing decision? Marketing manager must be well informed to the changes rate because they can affect demands for country's product at home and abroad. Effective managers should be alert in these aspects because it can save the company in terms of financial. For example, one of your suppliers abroad experience higher value exchange rate. So chances are your marketing team must find another suppliers in another country, or the company itself will double the budget to afford the higher rate. Second is production decision. A manufacturer in one country where wages and operating expenses are high might be tempted to relocate productions to a country with a currency that is rapidly losing value. For example, we all know that the Philippine peso has lower value than the US dollar. So there is a possibility that some US company will transfer their product here in the Philippines because of cheap cost. And lastly, the financial decision. Exchange rate can affect financial decision primarily in sourcing financial resources, remitting funds across national borders, and reporting financial reports. A company might be tempted to borrow money in a country where interest rate and exchange rate are lowest. To avoid high costs, a company should find a lender company that has a good rate interest and the lowest in terms in exchange rate.
And that's the end of our report. Thank you for watching and God bless you all.